Hello, this is Matthew Copley with Copley Financial Group, and today we're going to do a market update. I know a lot of you are watching your accounts and going, oh my gosh, what's going on? There's been a sharp sell-off in the markets across the board. Yes, the market has really come down. We're seeing the Russell 2000, the NASDAQ are in bear market down over 20%. Even the S&P 500 is down 16.5%. And so the market has had a huge sell-off, and it's obviously impacting your accounts. Now, that said, we're not down nearly as much as the rest of the market. We put a lot of hedges in place to protect your accounts. In fact, we sold a lot of our gains last year, which allowed us to have some hedges to protect us from this downturn. And normally that money was put on the sidelines in order to buy back in when the market has a big drop. And so when you see the S&P down 16.5%, hey, we should be buying back in. We're not quite there yet. The momentum is still pretty tough. We're seeing lower lows, lower highs. We're seeing the market trend down. Still a lot of recession indicators. I'm really concerned that this could turn into a larger overall recession. And the Federal Reserve hasn't even started really tightening yet. They've just clamped down, expanding the balance sheet, but they're still kind of maintaining the balance sheet, which is pretty nervous. In the event they do start tightening, it could be a more negative impact on the markets. Now, I think a lot of what they're saying they're going to do as far as buying back some of those bonds, I just don't see it happening. I don't see them raising interest rates any further. I mean, there already is so much damage. Interest rates, the 30-year fixed rate in August of last year was 2.5%. Today it's 5.54 as of today. That's a huge increase in 30-year fixed rates. It's going to have a huge impact on the housing market. Someone who had a $100,000 a year income actually could afford an $800,000 house with principal and interest payments on normal debt to income ratios. So if you had $100,000 in income, you could buy an $800,000 house. That was a year ago. Today, someone with a $100,000 income can only afford a house with about $560,000. And so it's a huge impact on the mortgage market. Tons of layoffs. All these companies that were big mortgage companies are laying off all their originators, a lot of their processors. The business is really dropping rapidly. So with all those recession indicators, we're still going to stay in a defensive position for a while. We still are overweight a lot of positions that I think are inflation hedges. And a lot of people think that coming recession is going to reduce inflation, and maybe temporarily. But unfortunately, with all of the monetary stimulus that the Federal Reserve's already put out, I just think inflation is still going to get worse. I think it's going to continue to be a problem. So we want positions overweight in energy, agriculture, precious metals, all those areas that are more traditional inflation hedges. So we've done that. We're overweight those positions in the portfolio. So it's working. The buffered index is fantastic. Continued market weakness will get reimbursed on those target dates when they hit. So pretty happy with the overall result, even though we're not happy that the market's down and some of your accounts are down. At the end of the day, they're not down nearly as much as the overall market. And that's why we put these hedges and things in place. So this is a time, by the way, that people make the biggest mistakes. So hopefully you don't make those mistakes. I see this typically when we have a big drawdown like this. There's always one or two clients that get really scared and they just want to sell, and you can't convince them otherwise. And so this is the time where people can make those mistakes, and hopefully we don't make those mistakes. We don't want to sell, especially after a big market drop like this. You want to let your accounts recover. Now, I can't promise they're not going to keep going down for a while. The market could keep trending down. The momentum's not looking good. But 2, 3, 4 years from now, it's going to turn out this is a great buying opportunity. Right now, it's a good buying opportunity. May not look good for a few months, but eventually it will. Inflation is going to take this right back up. And at some point, the Federal Reserve is going to take their foot off the brakes, and they're going to let the market rally back up, and they're going to try to create a little bit more of a easing environment, which will allow the markets to recover. So I don't know when that's going to happen. I imagine there's probably going to be a big push by the administration before the midterms to kind of help the economy out. So we may get a nice bump from now to then, but it probably will be inflationary. So continue to see the grocery prices and the gasoline price and everything continue up. I hate to tell you that, but that looks like where we're headed. So we're going to stay the course. We're going to stay in the defensive positions right now until we see a better opportunity. Momentum changes back up, then we're going to start deploying some of that capital. Normally when the market's down like this, we buy. Just not quite there yet. So hopefully that's a good market update on what's going on out there in the market. I know it's frustrating to see accounts down, but this is not unusual. What's unusual is the last couple of years. Normally you see a drawdown on average of about 16% in a normal stock market year. This means whatever the stock market starts at the beginning of the year, at some point there's a big drop, and that average drop is about 16%. And so we haven't seen that for a couple of years, and so people aren't used to it, and they kind of forgot what happens. The markets can be very volatile, and so those are typically really good buy points, and we're monitoring to see when we want to get a little bit more aggressive. We're just not quite there. So I hope that's a good market update. Thank you for watching, and feel free to call the office if you have any questions about your account. We'll be happy to talk to you.